The European Stability Mechanism is an intergovernmental organization located in Luxembourg City, which operate under public international law for all eurozone member states having ratified a special ESM intergovernmental treaty. It was established on the 27th of September 2012 as a permanent firewall for the eurozone, to safeguard and provide instant access to financial assistance programs for member states of the eurozone in financial difficulty, with a maximum lending capacity of €500 billion. It replaces two earlier temporary EU funding programs, the European Financial Stability Facility and a European Financial Stabilisation Mechanism. All new bailouts for any Eurozone member state will now be covered by ESM, while the EFSF and EFSM will continue to handle money transfers and program monitoring for the previously approved bailout loans to Ireland, Portugal and Greece. The treaty establishing the European Stability Mechanism stipulated that the organization would be established if member states representing 90% of its capital requirements ratified the founding treaty. This threshold was surpassed with Germany's completion of the ratification process on the 27th of September 2012, which brought the treaty into force on the date for 16 of the 17 members of the Eurozone. The remaining state, Estonia, which had only committed 0.19% of the capital, completed its ratification on the 4th of October 2012. A separate treaty, amending Article 136 of the Treaty on the Functioning of the European Union to authorize the establishment of the ESM under EU law, was planned to enter into force on the 1st of January 2013. However, the last of the then 27 European Union member states to complete their ratification of this amendment, the Czech Republic, did not do so until the 23rd of April 2013, postponing its entry into force until the 1st of May 2013. The ESM commenced its operations after an inaugural meeting on the 8th of October 2012. The first 40% of the paid-in capital was transferred by all ESM member states ahead of a treaty-regulated deadline of the 12th of October 2012. ESM member states can apply for a bailout if they are in financial difficulty, or the financial sector is a stability threat in need of recapitalization. ESM bailouts are conditional on member states first signing a memorandum of understanding, outlining a program for the needed reforms of fiscal consolidation to be implemented in order to restore the financial stability. Another precondition for receiving an ESM bailout is that the member state must have ratified the European Fiscal Compact. When applying for ESM support, the country in concern is analyzed and evaluated on all relevant financial stability matters by the so-called Troika in order to decide which of its 5 different kinds of support programs should be offered. As of April 2013, the ESM has approved 2 financial assistance facility agreement programs, with up to €100 billion earmarked for recapitalization of Spanish banks, and €9 billion in disbursements for Cyprus for a sovereign state bailout program. The Cyprus bank recapitalization was funded by converting bank deposits into equity. History. Following the European sovereign debt crisis that resulted in the lending of money to EU states, there has been a drive to reform the functioning of the Eurozone in the event of a crisis. This led to the creation, amongst other things, of a loan mechanism, the European Financial Stability Facility and a European Financial Stability Mechanism. These, together with the International Monetary Fund, would lend money to EU states in trouble, in the same way that the European Central Bank can lend money to European banks. However, the EFSF and EFSM were intended only as a temporary measure, in part due to the lack of a legal basis in the EU treaties. In order to resolve the issue, the German government felt a treaty amendment would be required. After the difficult ratification of the Treaty of Lisbon, many states and statesmen opposed reopening treaty amendment, and the British government opposes changes affecting the United Kingdom. However, after winning the support of French President Nicolas Sarkozy, Germany won support from the European Council in October 2010 for a new treaty. It would be a minimal amendment to strengthen sanctions and create a permanent lending out mechanism. It would not fulfill the German demand to have the removal of voting rights as a sanction, as that would require deeper treaty amendment. The treaty would be designed so there would be no need for referendums, providing the basis for a speedy ratification process, with the aim to have it completely ratified and come into force in July 2012. In that case, it was to coexist with the temporary lending out mechanism for 1 year, as EFSF was set only to expire as a rescue facility at the 1st of July 2013. Treaty basis. Article 136 Amendment of TFEU. On 16 December 2010, the European Council agreed a two-line amendment to Article 136 of the Treaty on the Functioning of the European Union, that would give the ESM legal legitimacy and was designed to avoid any referendums. The amendment simply changes the EU treaties to allow for a permanent mechanism to be established. In March of the following year, leaders also agreed to a separate eurozone-only treaty that would create the ESM itself. In March 2011, the European Parliament approved the treaty amendment after receiving assurances that the European Commission, rather than EU states, would play a central role in running the ESM, despite wishing it had been more involved earlier, and it was signed by all 27 EU member states on 25 March 2011. The amendment reads: the amendment authorizes the Eurozone countries to establish a stability mechanism to protect the common currency within EU law. This means that the existing intergovernmental treaty having established ESM outside of the EU framework with entry into force 27 September 2012, might subsequently be transposed to become part of the EU framework once this TFEU Article 136 amendment enters into force. The ESM established by the Intergovernmental Treaty was designed to be fully compatible with existing EU law, and the European Court of Justice ruled in November 2012 that the right of a member state to conclude and ratify the ESM treaty is not subject to the entry into force of the TFEU amendment. The TFEU amendment came into force on 1 May 2013, after the Czech Republic became the last member state to ratify the agreement according to its respective constitutional requirements. In June 2015, an updated EMU reform plan was released which envisaged that in the medium term the ESM should be transposed from being an intergovernmental agreement to become fully integrated into the EU law framework, applying to all Eurozone member states under the competence provided for by the amended Article 136 of the TFEU Treaty establishing the European Stability Mechanism. In addition to the TFEU Amendment Treaty, the European Stability Mechanism itself was established by a treaty among the Eurozone states, named the Treaty Establishing the European Stability Mechanism, which sets out the details of how the ESM would operate. Formally, two treaties with this name were signed, one on the 11th of July 2011 and one on the 2nd of February 2012. After the first turned out not to be substantial enough, the second version was produced to make it more effective. The 2012 version was signed by all 17 eurozone members on the 2nd of February 2012, and was planned to be ratified and enter force by mid-2012, when the EFSF and EFSM were set to expire. The treaty was concluded exclusively by eurozone states, amongst others because the UK refused to participate in any fiscal integration. The treaty establishing the ESM entered into force on the 27th of September 2012 for 16 signatories. Estonia completed the ratification on the 3rd of October 2012, 6 days after the treaty entered into force. However, the inaugural meeting of the ESM didn't occur until the 8th of October, after the treaty's entry into force for Estonia. Latvia's adoption of the euro on the 1st of January 2014 was given final approval by the Economic and Financial Affairs Council on the 9th of July, making them eligible to apply for ESM membership. Following Latvia's government giving the consent to joining to the ESM in November 2013, they acceded on the 21st of February 2014. The treaty entered into force for them on the 13th of March 2014. Latvia's contribution to the ESM will be €325 million. Lithuania adopted the euro on the 1st of January 2015 and acceded to the ESM on the 14th of January 2015. They became a member on the 3rd of February 2015. Organization. The ESM is an intergovernmental organization established under public international law, and located in Luxembourg City. It has about 145 personnel, who are also responsible for the EFSF. The organization is led by a managing director appointed for a 5-year term. The first managing director, Klaus Riegeling, was appointed in 2012. Each member state appoints a governor for the Board of Governors, which can either be chaired by the president of the Eurogroup or by a separate elected chair from amongst the governors themselves. In 2012, Jean-Claude Juncker was appointed to this position. The board consists of ministers of finance of the member states. The board of directors consists 17 members of high competence in economic and financial matters. Each member state appoints one director and an alternate. Financial support instruments. ESM member states can apply for an ESM bailout if they are in financial difficulty or the financial sector is a stability threat in need of recapitalization. ESM bailouts are conditional on member states first signing a memorandum of understanding, outlining a program for the needed reforms of fiscal consolidation to be implemented in order to restore the financial stability. Another precondition for receiving an ESM bailout, starting from the 1st of March 2013, will be that the member state must have fully ratified the European Fiscal Compact. When applying for ESM support, the country in concern will be analyzed and evaluated on all relevant financial stability matters by the so-called Troika in order to decide if 1. Several of these 5 different kind of support programs should be offered. Stability support loan within a macroeconomic adjustment program, to be granted if it is no longer sustainable for the state to draw on capital markets when seeking to cover the state's financial needs. The signed conditional MOU agreement will focus on requirements for fiscal consolidation and structural reforms to improve the sovereign financial stability. bank recapitalization program, to be granted if the roots of a crisis situation are primarily located in the financial sector and not directly related to fiscal or structural policies at the state level, with the government seeking to finance a recapitalization at sustainable borrowing costs. ESM will only offer a bank recapitalization support package if it can be established that neither the private market nor the member state will be able to conduct the needed recapitalization on their own, without causing increased financial stress, instability. The size of the needed recapitalization shall be determined by a stress test, calculating the amount needed for a complete financial sector repair to eliminate all vulnerabilities. Support from this ESM package is earmarked for bank recapitalization and cannot be used for any other purpose. The signed conditional MOU agreement will likewise only cover requirements for reform, changes to the financial sector, within the domains of financial supervision, corporate governance and domestic laws relating to restructuring, resolution. Precautionary financial assistance comprise support in the form of setting up available credit lines the ESM member state can draw on if suddenly needed. This support shall be offered to ESM members whose economic conditions are currently sound enough to maintain continuous access to market financing, but being in a fragile situation, calling for the setup of an adequate safety net to help ensure a continued access to market financing. The signed conditional MOU agreement will focus on requirements for fiscal consolidation and structural reforms to improve the sovereign financial stability. Primary market support facility. Bond purchase operations in the primary market could be made by ESM, in complement to offering regular loans under a macroeconomic adjustment program at a drawdown of funds under a precautionary program. This instrument would be used primarily towards the end of an adjustment program to facilitate a country's return to draw on the market, and reduce the risk of a failed bond auction. The aim is for the private market to subscribe to 50% of the bond auction while ESM cover the remaining 50%. If the participation of the private market proves to be insignificant, the PMSF will be cancelled and replaced by an extra transfer of funds from the macroeconomic precautionary program. There will be no additional MOU agreement for this support package, as the conditions will be identical to the pre-existing sovereign bailout loan precautionary program. Secondary market support facility. This facility aims to support the good functioning of the government debt markets of ESM members in exceptional circumstances where the lack of market liquidity threatens financial stability, with a risk of pushing sovereign interest rates towards unsustainable levels and creating refinancing problems for the banking system of the ESM member concerned. And ESM secondary market intervention is intended to enable market making that would ensure some debt market liquidity and incentivize investors to further participate in the financing of ESM members. The instrument can be offered either as a standalone support, or in combination with support from any of the other four instruments. No additional MOU agreement will be needed for ESM members already receiving a sovereign bailout loan precautionary program, but a non-program country will obviously need to sign a MOU agreement with the policy conditions outlined by the European Commission in liaison with the ECB. In order to further help increase the financial stability of the eurozone, the ECB decided on 6 September 2012 to automatically run a free unlimited amount of yield-lowering bond purchases for all eurozone countries involved in a sovereign state bailout, a precautionary program from EFSF, EFSM, if and for as long as the country is found to suffer from stressed bond yields at excessive levels, but only at the point of time where the country possesses, regain a complete complete market funding access, and only if the country still complies with all terms in the signed MOU agreement. Countries receiving a precautionary program rather than a sovereign bailout will per definition have complete market access and thus qualify for OMT support if also suffering from stressed interest rates on its government bonds. In regards of countries receiving a sovereign bailout, they will on the other hand not qualify for OMT support before they have regained complete market access, which the ECB define as the moment when the state succeeds to issue a new 10-year government bond series at the private capital market. Initially, EFSF and EFSM were only allowed to offer financial stability loans directly to sovereign states, meaning that offered bank recapitalization packages were first paid to the state and then transferred to the suffering financial sector, and thus, these type of loans were accounted for as national debt of the sovereign state, adversely impacting its gross debt to GDP ratio and credit rating. In example, this regime was utilized when the ESM established a bank recapitalization support program for Spain in 2012-13. On the EU summit on 19 October 2012, it was decided that ESM bank recapitalization packages in the future instead only shall be paid directly to the financial sector, so that it no longer counts as state debt in the statistics. ESM made the decided direct bank recapitalization framework operational starting from December 2014, as a new novel ultimate backstop instrument to apply for systemic banks in the recovery resolution phase, if such banks will be found in need to receive additional recapitalization funds after conducted bail-in by private creditors and regulated payment by the Single Resolution Fund. In this way, the primary backstop to patch future uncovered recapitalization needs of a failing systemic bank will be provided by bail-in of private creditors, along with contributions from the Single Resolution Fund, while the ESM direct bank recapitalization instrument only will be needed as an ultimate backstop for the most extreme cases where the primary backstop funds are found to be insufficient. Contributions. The ESM is expected to have an authorized capital of €700 billion, of which 80 billion is paid in capital, and the remaining 620 billion, if needed, will be loaned through the issuance of some special ESM obligations at the capital markets. The ESM treaty foresees a payment of the capital in 5 annual installments, but the Eurogroup decided on the 30th of March 2012 the capital payments shall be accelerated and all the capital paid by the first half of 2014. The following table shows the part each member state has to pay following the ESM treaty. At the moment when ESM has received all its paid-in capital from the eurozone countries, the ESM will be authorized to approve bailout deals for a maximum amount of €500 billion, with the remaining €200 billion of the fund being earmarked as safely invested capital reserve. In order to guarantee the issuance of ESM bonds will always get the highest AAA credit rating, with the lowest possible interest rate at the current time. 40% of the paid-in capital shall be transferred on the 12th of October 2012, with the remaining 3 times of 20% transfers scheduled for Q2-2013, Q4-2013 and Q2-2014. Is the ESM lending capacity depends on the amount of paid-in capital. It will start out only to be €200 billion in Q4-2012, and then be increased with €100 billion each time one of the remaining 3 capital transfers ticks in. If needed, a majority of the ESM board can also decide to accelerate the payment schedule. On the 1st of May 2013, ESM has reconfirmed the schedule for receiving paid-in capital, with the third tranche already received in April 2013, followed by the fourth in October 2013, with the final fifth tranche scheduled for April 2014. Lending activities. The Troika currently negotiates with Spain and Cyprus about setting up an economic recovery program in return of providing support with financial loans from ESM. Cyprus so far applied both for a €6 billion sovereign bailout loan and a €5 billion bank recapitalization package. Cyprus could, however, perhaps also be interested in additional support packages from Instrument 3/4. Reportedly, Spain, beside of applying for a €100 billion bank recapitalization package in June 2012, now also follow a path of negotiations to get financial support from a precautionary conditioned credit line package. If Spain will apply and receive a PCCL package, irrespectively to what extent it subsequently decides to draw on this established credit line, this would at the same time immediately qualify the country also to receive free additional financial support from ECB, in the form of some yield-lowering bond purchases. The table below provides an overview of the financial composition of all bailout programs being initiated for EU member states since the global financial crisis erupted in September 2008. EU member states outside the eurozone have no access to the funds provided by EFSF/EFSM, but can be covered with rescue loans from EU's Balance of Payments Programme (IMF) and bilateral loans. Since October 2012, the ESM is a permanent new financial stability fund to cover any future potential bailout packages within the eurozone, has effectively replaced the now defunct GLF plus EFSM plus EFSF funds. Whenever pledged funds in a scheduled bailout program were not transferred in full, the table has noted this by writing Y out of X. Critics have noted that the ESM severely confines the economic sovereignty of its member states and criticize that it provides extensive powers and immunity to the board of ESM governors without parliamentary influence or control. Think tanks such as the World Pensions Council have argued that the European Stability Mechanism is the product of a short-term political consensus, and thus won't be conducive of a durable, cohesive institutional solution. In the perspective, a profound revision of the Lisbon Treaty itself is unavoidable if Germany is to succeed in imposing its economic views. As stringent orthodoxy across the budgetary, fiscal and regulatory fronts will necessarily have to go beyond the treaty in its current form, thus further reducing the individual prerogatives of national governments. In Estonia, a group of MPs have called for a referendum on the treaty. On the 8th of August, during the first reading of the bill ratifying the ESM in Riigikogu, the Estonian Centre Party put forward a motion to reject the bill. However, this motion was defeated in Parliament by 56 votes against, with 33 voting for. In Germany, some members of FDP and CSU, both minor parties of the previous government coalition, were against the European Stability Mechanism. The Left Pirate Party Germany and NPD also opposed the ESM, the latter comparing it with the Enabling Act of 1933. Finland. Both opposition parties, the True Finns and the Centre Party, oppose the ESM. France. Left Front and left-wing presidential candidate Jean-Luc Mélenchon oppose the ESM. Netherlands. The Socialist Party opposes the ESM. Geert Wilders' Party for Freedom opposes any increase or systematization of transfer payments from the Netherlands to other EU countries, through means such as the ESM. Slovakia. An opposition Liberal Party, Freedom and Solidarity, is a staunch opponent of the ESM.